Hello, everyone. Thank you for joining us for our 2023 fourth quarter town hall. We appreciate you all being with us this afternoon. We're going to walk through a 30 to 40 minute presentation, and then we'll take some questions at the end. If you have a question you would like to submit, please enter it into the Q&A section of your Zoom. Our theme for this town hall is going to be sailing on strange seas. We do believe we are at an inflection point for both the economy and the markets, and we're going to talk through that here today. Here are the 7 topics we're going to discuss today. The topics range from the economy, mentioning politics briefly since we are coming up on an election year. We're also going to talk about fixed income in conjunction with interest rates, talk through equities, and how earnings will need to drive this market higher. In reference to our sailing theme, something that any experienced sailor knows is you don't sail a boat backwards. Often, the calm waters of yesterday don't last, so we need to look forward and be prepared for what's coming. In relation to the financial markets, investors can say the same. You can't rely on the past. You have to look forward. When we look back over the last few years, there is no doubt there has been good wind in the sails of the economy, pushing it forward in the form of these 4 components. Low interest rates, easy to borrow money to fuel growth, record fiscal stimulus, an incredibly strong labor market, record consumer spending, especially of late when it comes to travel and leisure. These winds are dying down, and we can't count on the smooth sailing we've seen here to date. Looking forward, we are likely to see waters that are more challenging and choppy. To navigate these waters, we look at the tools at our disposal. First, we have real-time economic indicators. They give us the early warning signals to changes to the economy. Next, we look at historical analysis. That gives us a map to what we've seen in the past. We also look at valuations. They give us perspective on the performance to expect going forward. We look at what policymakers are doing, both Congress and the Fed. Bottom line is, the past is of little use. You have to be prepared for the winds are blowing today, and that is what this presentation is all about. Now, looking at the economy, there does appear that some storm clouds are building on the horizon. The reason? Stimulus is fading. We had $2.1 trillion in excess savings in consumer bank accounts. We've had rates near zero, which made it easy for businesses and consumers to get access to money. And we've had a Fed that was buying a significant amount of treasuries to keep interest rates low. Those tailwinds are gone. When you look at excess savings, for example, on the left-hand side of your screen, as I just mentioned, at one point, was $2.1 trillion. As we sit here today, economists believe we have evaporated all of those additional savings. And when you look at the fixed costs that consumers have to take on today, it continues to grow significantly. If you look at the graph on the right-hand side of the screen, the average mortgage for the average person is $2,250 a month. And this excludes home insurance. The average auto loan is north of $700 a month, and that excludes auto insurance. Average amount for gas is $200 a month. When you add all of this up, it's north of $3,000 a month for these costs for these consumers. The significance of this, that is an increase of 78% since COVID started. The contribution of our economy coming from consumers is likely to fade. Combine that with our expectation that you're likely going to see some weakness in the employment market. As you see on the chart on the left-hand side of your screen, as early as the beginning of next year, you could see job growth turn negative. That, along with the fact that banks are getting more stringent with lending out money to both consumers and businesses, you can see that on the chart on the right of your screen. Now, in many ways, banks getting more stringent may be warranted. If you look at delinquencies, they are starting to rise. Credit card delinquencies are at the highest level in more than a decade. And with savings being depleted and access to credit getting more challenging, you're starting to really see that impact the consumer. Now, to see this, we look at real-time indicators. One of those is credit card spending. The chart on the left shows that when you look at credit card spending over the last few months, it has either flatlined or gone slightly negative. Also, when you look at the headlines on the right-hand side, you are seeing a consumer demand that is starting to soften. It starts with travel. You look at people getting on airplanes, it's starting to stall. Airfare prices are down 15% year over year. A lot of the luxury brands are noting that the consumer is starting to weaken. And all of these headlines don't take into account that starting October 1st, tens of millions of student loan borrowers are now paying $200 to $300 a month to pay back their student loans. Raymond James did a survey. They asked those respondents, are you going to spend more over the next 6 months than you did over the last 6 months? Only 5% of responders said they're going to spend more. And 33% of them said they're going to spend less over the next 6 months, a time period that includes the holiday shopping season. And since the consumer is such a driver of the economy, that could potentially lead us into a mild recession. Despite the fact that many people think that this economy is too resilient, we think we potentially see a mild recession next year. And the clouds can come in very quickly. If you look at this chart on the left-hand side over the last 12 recessions, you see the dark blue bars. The dark blue bars were what growth was the quarter before we went into a recession. The average growth was 2.6%. Pretty healthy growth. The following quarter, the light blue bars, is when we went into a recession. You see in that quarter, growth fell 3.5%. That is a significant, quick change, a reversion of over 6%. The turnaround can happen very quickly. We think we could see a mild recession in the first quarter of next year. The graph on the right shows Raymond James economic forecast. They are forecasting a shallow recession. You can see that on the chart on the right, and it's expected to be mild. Many economists think the economic contraction may be a quarter of what you would usually expect from a recession. GDP growth expected to contract 0.6%. An average recession, it contracts 2.5%. Thinking it will be short in duration, maybe 6 months. Average recession, 10 months only. Expecting the number of jobs lost in totality will be less than 500,000 versus an average of 3.5 million. Now, the reasons we are thinking it will be a mild recession. First, overall, we have a healthy consumer. We haven't seen consumers get over-leveraged. 70% of mortgages are at a fixed interest rate of 4% or lower. We still have a healthy job market. Right now, over 9 million job openings. Plus, we don't think you will see massive layoffs because businesses have had such a hard time hiring people and finding talent over the last couple of years. We think they'll be slow to lay people off. And we have few excesses to be worked off. We don't see a housing bubble. We don't see bloated inventories that need to be worked off. We also have solid government spending. There have been significant packages put in place that will dole out money over the next couple of years. We have the CHIPS Act, the Inflation Reduction Act. They've already been passed, but a lot of that money hasn't been spent yet. We are already seeing rolling recessions in certain sectors. The freight industry is likely already in a recession. We have certain retail areas where you've seen a recession already. Raymond James, during their study, survey, they asked consumers about an upcoming recession. Only 12% of survey respondents do not expect a recession over the next 12 months, which means 88% of respondents think a recession is coming, which means if they are expecting a recession, they've likely already adjusted their spending. So we don't think that you're going to see everyone adjust their spending all at once, which could potentially cause a more severe recession. Now, Don's going to walk us through where we are at with monetary policy and where we think it's going.
Thank you, Vanessa. Appreciate it. Hello, everyone. Appreciate you joining us today. Thanks again. To Vanessa's point, everyone knows that elected officials increase the odds of staying in power most often by spending money and keeping the economy going. Hardly anyone is reelected in a recession. The Federal Reserve's job is to maintain full employment and steady growth without overheating the economy, leading to inflation, and in turn having to implement restrictive monetary policy to slow things down. So the perfect scenario is when Congress and the Federal Reserve basically work together. But what happens when politicians start to see the trend of Vanessa's slides and decide to blow out the budget instead? Well, then the Fed has to overreact the other way, leading to a tug of war between huge deficits expanding at record rates and controlling inflation. It's kind of a lose-lose scenario. Basically, the mad dash to rates that we saw begin in January of 22, and as some of you may recall, at that time in late 21, the Fed thought they would raise rates 3 or 4 times in 22. Then in January, it was, we're going to raise it faster. By February, it was, we're going to have 8 to 10 rate increases. And by March, the race was on. So this is the Federal Reserve with all known data, couldn't figure it out within that any time period, let alone raising that pace over the 90-day period and then beyond. In 2018, a little context, in 2018, the US budget was $4 trillion. In 2023, they're negotiating right now, as we know, we're up against another deadline for November 17th. They're negotiating around 6.4 trillion. To put that in perspective, in those 5 years, the US has had 1% annual population growth, or 5% total, but they're negotiating a 65% increase in the budget because they're scared, again, going back to Vanessa's slides and those trends, they're scared of having us going into a recession or worse. The challenging part for us as advisors is that they're talking about 3% GDP growth on a $6.4 trillion budget, which again is 65% greater than just 5 years ago. But now onto the slides, onto the next slide there. The slide on the left shows inflation, which we've talked about in our town halls for the last couple of years, which measures the rise in the price for a basket of goods and services over a period of time. And it's true, the increase in annual inflation is coming down from high levels, if you remember, is 9%, I believe last August or September. But that doesn't mean that the overall prices for these specific goods are coming down. They're simply continuing to rise at a slower pace. If you ever checked out a bag of groceries lately, it's crazy expensive. It is yet to be seen if inflation year over year remains contained once the new budget is approved in the coming weeks because of that $2 trillion deficit. A quick reminder on the CPI component of the inflation, the main components are food, which is 15% of the component, housing, but in the form of rent, is a 42% component. So the largest single component in figuring out year over year consumer price index is rent. Again, not the increase in home prices, that has no correlation. It is the actual rent that renters have to pay, and what does that rise year over year? Apparel is 4%, transportation, which is basically oil, is 17%, the medical is 7%. So those are some of the major components. The slide on the right needs some explanation. This chart shows the prices of online goods is coming down, and this can be confusing when we're saying there's still inflation. The price of an item contains the cost to make the item at a profit margin. With supply chains easing, the profit margin is shrinking, which is leading to less gouging, which is leading to lower prices, but the internal components to make them keep creeping a little bit higher. We're also hearing a lot of talk about recession that Vanessa noted, but we're not too concerned, one, because Congress is spending, and two, to keep in mind that with a $21 trillion economy back in 18, and our economy now is pushing 30 trillion. In fact, my notes don't show, it's pushing 30 trillion. The challenges we have is if we go from 30 trillion down to 29 trillion, but just a few years ago, we were sitting at 2021, it's not the end of the world type of thing. We'll have a modest pullback. We actually had a recession in 22. The second and third quarters were slightly down, but it didn't get a lot of press because it was such a nominal notch lower at a time when the economy in general is doing okay. So the news headlines gets a lot of publicity on recession. We're paying attention to it, but the numbers that Vanessa shared are very shallow. And if that's where we are, not a worry. In fact, the Fed just closed out their November meeting yesterday and said that they even think we might skip a recession. So either very shallow, like Vanessa noted, or maybe even less than that. We might not even get into one. On the next slide, the biggest component, as I mentioned, in inflation reading is the rental rates, not actual home prices. Again, that's not part of it. But if you used real-time data on rents from rent.com versus the government kind of delayed reaction, then these numbers are actually coming down faster than what this chart is showing us. So there's a real chance that some component, the largest component of inflation, could find itself being a bit under control. Vanessa had a similar slide where she had that box showing how the year-over-year numbers are taking a look at. Same thing is for the rent. You can see in this chart here, to go back to May and November of 22, and we're in that time frame now, how the rent increases were approaching 9%, and now we're down to the 3-4 range. So as those numbers roll off, and the lower numbers are now part of the component calculation for CPI, we fully expect to see some lower numbers from an inflationary perspective, which could give the Fed a little breathing room, again, adding to why they have decided yesterday to take a pause, and that may carry into the first year, when just a couple months back, they were thinking that they might raise one more time this year. On the next slide, there are some things that affect consumers, and we have revolving credit. You can see this chart here. Revolving credit was just under $1 trillion right during COVID, and now all of a sudden have about a 30% increase, getting us on the verge of 1.3 trillion in credit card debt. So when we look at interest rates rising, what the Federal Reserve has done to the economy to try and slow it down, everything goes up, from the home mortgages to car loans to credit card to home equity line of credits to commercial loans. Everything interest rate sensitive now has a higher cost of capital to it. Well, these credit cards here, now that we're at 1.3 trillion, is building up a little bit of a problem for the average consumer, because they have gone through their savings that they had. They're starting to borrow on credit. And once that credit gets tapped out, that's what we're focused on, is what happens at that point. On the middle slide there, middle graph, housing affordability, auto affordability, things that consumers either desire or need, the cost, we don't see any car loans at 0%, 0.9%. We're seeing stuff at 7 and 8%. Subprime auto, people who unfortunately have poor credit, are looking at auto loans between 14 and 20%. So things are very tough out there. And then on the right-hand side, it gets back to that government interest spending. The Fed took interest rates from basically zero on short-term rates in January 22 to approximately 5.5% today. Well, when you're sitting on $33 trillion of deficit, adding $2 trillion a year, the interest rate curve today on that $2 trillion is between short-term of 5.5% and longer-term somewhere in the mid-4s. So let's call it 5. You add $2 trillion of debt, that's $100 billion a year forever of added cost just to cover that interest. And as more and more government debt comes due and has to get reissued, there's going to be trillions coming due that we were paying, or the government was paying 0 to 1-2%, now paying 4s and 5s. And so the interest component, shown on this graph, is again another concern that we're going to be paying a lot of attention to, and some people should be aware of. On the next slide, the Fed funds forecast is basically what do we think, and what does our partners at Raymond James think is going to happen in the coming cycle here with the Fed. And overall, people think the Fed is either done or near done. We did expect an interest rate increase a few months back to happen today, which it did not. The recent economic news gave them an opportunity to give it a pause. So right now, this could be the end of it. Maybe 1 or 2 more coming up next year. But they're going to it appears the Fed's going to let the interest rates run through the economy based on all the things we just talked about credit card debt, mortgages, auto loans, et cetera. Just work through and make sure that they don't press too hard on the consumer, while at the same time trying to rein in the inflation. So at times it is a thankless job, but they're going to let things go as they are at the moment. And then oil prices were in the $60 a barrel range in the summer. We unfortunately are entering into another Middle East conflict that had oil run into the 90s, and now we're somewhere in the 80s. So oil, which really is transportation in a sense, is 17% of CPI, but it does affect many components underneath the surface. So we're going to pay attention to oil, and hopefully the conflict does not escalate, because if it does, then oil could easily pass the $100 mark and stay up there for the entirety of the conflict. So we're hoping and praying for peace talks sometime soon. That'd be the best of all worlds. On the next slide, Very hot topic. We're actually going to let this one go for the time being. You know, we're headed into an election year. Just grab your popcorn. It's going to be an interesting year. It will be eventful. We'll have more on this, on the status of politics and what we're seeing as far as it's about time for the politicians to come out with more definitive talks, whether it's president or Senate or House, and come up with their ideas on budgets and cutting spending or where they want to spend. And we'll have more of this in the coming year, but it's going to be quite the topic. So we'll do more of that then. On the next slide, we're going to talk about a little bit about fixed income, which relates to the Federal Reserve. So it's been a terrible couple of years for bonds. As I mentioned, the Fed just had their meeting yesterday and decided to take a pause, thankfully. We think part of that is due to higher rates and everything that is going on right now and how it's affecting people. And a little bit that's not front and center yet is that a lot of banks, a lot of local banks, we're all familiar of Silicon Valley Bank going under and First Republic being taken over by JP Morgan Chase. Those were due to mortgages being written at low rates with rising rates. Well, banks, local community banks and mid-sized banks have a lot of commercial loans that have also been written that have notes coming due. There's a couple $100 billion coming due in the next 2 years. And they've got to figure out with COVID issues, people working from home, lower occupancy rates, which leads to lower rental rates, and then higher interest rates, which makes it harder to service the debt. So you actually need the income to do that. Those are 3 or 4 different crosswinds that don't bode well for certain commercial properties, such as office buildings. So we're going to be paying attention to that in the banks and how they deal with it. And in fact, it's such an issue right now in the mind of Congress that they're already working on bills to figure out how to avoid a 2008, 2009 Great Recession type thing where we had the housing market absolutely collapse. They're trying to figure out what can we do from a tax perspective to minimize the downdraft of what is evidently in front of our face right now, which is a lot of loans coming due on property values that are not doing too well. So we'll be taking a look at that. The inflation itself and then the Fed decisions and its effects on bonds and money market rates are going to be front and center all year along with the election. So next slide. Here we have, you know, every year Wall Street puts out their predictions, and what we're seeing is that, and this is from these numbers are a couple months old. We've had a challenging October, although a nice little rally this week. This is what prominent people thought, and then the inverse happened to be true. And for our clients, they know that there's been about 7 stocks that really carried us, and Aaron will talk more about returns. So I'm going to focus on the slide on the right here. The bond aspect, when it says investors have never been this short of bonds, that's really pension funds or institutions. Our clients are either long money market T-bills or bond funds, and we do some tax loss harvesting when appropriate in there. But the market's been so one-sided, betting that the Fed would keep going. We think with the Fed pausing and this kind of position that we should get some kind of relief in here for a little bit. Doesn't mean the end of inflation, but some little pause here and some kind of relief in this. So we're hoping that bond funds are allowed to perform as they're meant to do going forward. Next slide, please. Thank you. The other thing that we're watching out there is that we are on pace for a 10-year high in bankruptcies of small and mid-sized companies, because again, what the Fed has done, no one comes out unscathed, especially businesses that need to borrow money. And if you could borrow money at 2 and 3%, and now it's 8, 9, and 10, that's a big difference for businesses that were either trying to grow, trying to make it, and with many aspects of the economy slowing, it's tough to keep up with a significantly higher cost of capital or debt to run and grow your business in a slow economy than vice versa. So there is some unfortunate pain there. We're seeing it, but because Congress is spending so much money, again, our deficits would usually be 100 billion, 200 billion, 300 billion. They're looking at 2 trillion. They're spending to try to keep the major components of this economy going. And so there is also some high yield corporate refinance risk coming out, where companies have a lot of debt coming due in the coming year, year and a half, and then beyond, that higher rates, tougher underwriting guidelines, credit risk, et cetera, it's not going to be easy. So we think these bankruptcies are going to last for a while, but the larger S&P 500, larger corporations that we invest in are going to be okay. So with that, if we can have the next slide, I'd love to turn it over to our partner, Aaron Peabody. Thank you.
Thank you, Don. So excited to talk through the equity markets, and I like this first slide here because it's frankly great timing to start to look at kind of what's been going on in the equity markets. So we're looking at the S&P 500 here, and looking at all of the different events that have happened thus far this year, and we see the market kind of off to a nice start, January through February, little pullback going into March, and then a really nice climb out of the FOMC meeting at the end of February, early March, all the way through July. And I mentioned it's interesting timing because what you see here is that the S&P 500 has peaked most recently in July, and we've been in a couple month downdraft here. And it just speaks to investor sentiment, because if we look point to point on where the S&P started at the beginning of the year back in January, to where the S&P was just a couple months, a month ago, when we had kind of this 10% pullback from the top, point to point, the S&P 500 was still up 10%. But as investors, we weren't feeling that great because we got, August, September, October statements back to back to back with downdrafts in the equity markets. And so it's just an interesting thing to note, always important to remember. We get really caught up in high watermarks and low watermarks. But the economy is going to ebb and flow. The markets are going to ebb and flow. It's entirely normal for the S&P 500 to be off more than 5%, 3 to 4 times in a calendar year, even when we have positive returns in the markets, which again is why we don't want to play the game of timing the markets. We want to stay invested and remember our time horizons as we're starting to make investment decisions. Now, as we move forward in the presentation, there's a couple of factors that play into these returns that we have in the markets. And so what we're looking at here on the left side is the components around earnings per share. So how profitable have the companies been? And then secondarily, that dark blue line, which is the PE multiples. So our price to earnings multiples, meaning the higher the price to earning multiple, the more optimistic investors are, the more they're willing to pay more money for that same earnings potential. And what you see here in 2023 is that a lot of this increase in the equity market, specifically the S&P 500, has been predominantly driven by a price to earnings expansion. So we were trading at about 17.5 on the price to earnings, now closer to about 19.25. A lot of that driven by this optimism around artificial intelligence and the impact that AI could have on the markets moving forward. It's a great reminder that this stock market is a forward-looking mechanism. It cares what happened last. So they talk about quarterly performance on these earnings calls, but what the market's really interested in is not just the quarterly performance looking backwards, but what are our expectations moving forward? And we've seen this expansion in the equity markets predominantly driven by these expansions in price to earnings. So why are people willing to pay higher multiples for these stocks? We've had a less aggressive Fed in 2023 than we had in 2022. As you guys recall, we had a very aggressive Fed on an interest rate hike in 2022, starting to slow down a little bit in 2023. We're starting to get inflation under control, and people are starting to see some end in sight. Again, there's still some concern around potential inflation. There's still some concern around the individual, as Vanessa mentioned, spending through their excess savings. But if the government's budget comes in north of $6 trillion, that's additional stimulus, that's additional capital making its way into the market. That's improving the overall investor sentiment. It's not uncommon when we look at historical performance in the markets for price to earnings multiples to expand at the early stages of an economic expansion. Because again, the market's looking forward, so there's some signs of hope down the line. The market wants to get ahead of that, starts trading at higher multiples, and then the market starts to catch up with ourselves. What we need to do here, though, is we need to start seeing that earnings potential start to grow so that this rally can be a sustainable market growth for years to come. So let's jump to the next slide here. There's a lot on here, so apologize for that. But there's a couple of factors, again, that we're looking at here when we're talking about earnings. On the far left, we're looking at top line, so GDP growth and general expectations. As Don mentioned earlier, we're expecting 2 to 3% GDP growth. Now, if our top line numbers are running at 2 to 3% companies' gross revenues, in order to get expansion in earnings, we need to be able to control costs or have costs come down. Now we're still in a relatively, we're still experiencing some inflation, so we're not seeing the cost of goods and services coming down dramatically. And so if we get 2 to 3% earnings growth with relatively stable to slightly increasing with inflation expenses, you'll see here on the right, the expectation is that earnings kind of tread sideways from the end of 2023 at $220 on the S&P 500 to 220 at the end of 2024 as well. We've got to get the underlying economy to pick up and get that growth on the top line to be able to get those earnings per share to continue to drive higher, because we do have some headwinds with inflation. And again, just the cost for businesses from a capital perspective, interest is more expensive now. Now, as we look here on the next slide, the other big wind at our sails that we've had over the last decade or so is with these low interest rates that we've been experiencing. Companies have been taking those low interest rates, borrowing money to buy back their stock. So if they think they can borrow money at 2, 3, 4%, and they think the stock is going to do better than 2, 3, 4%, then you're better off borrowing money, buying your stock back, and letting that stock value increase. That is a buyer for stocks. If companies are buying back their shares, that's another buyer in the market that drives values higher. Companies have to look, though, a lot more diligently about stock buybacks when your cost of capital went from 2, 3, 4% to 5, 8, 9, 10%. And so you're seeing a lot less company buybacks. You're seeing a lot less increase in dividend rates on the S&P 500 companies. And so again, we need the earnings to pick up to help continue to drive markets moving forward. On the right side, we look at the relative attractiveness between equities and bonds. So if you guys recall in conversations with your advisor over the last few years, there was periods of time, as you can see here in the chart back in 2019, 2020, when the yield that you got from the S&P 500, so that dividend that you were being paid to own the S&P 500, was actually greater than the interest that you got loaning money to the government for 10 years. So you had a decision, do I loan money to the government for 10 years at a lower income than what I could get for the S&P 500? And when interest rates were at 1, 2, 3, 4%, it was hard to be an investor in that space and know that your money was going to be able to grow to take care of you for a 30-plus year retirement. And so that pushed money that would historically have been in bonds into the equity side, into the stock side of the portfolios, because that was the only way it was going to have an opportunity to grow enough to keep up with inflation and grow enough to take care of a 30-plus year retirement. That ebb and flow, though, is starting to happen where now an individual has to make a decision. Do I want to give up a rate of return of 5, 6, 7% in bonds to now be a stock investor? And so it just changes your risk reward dynamics when the less volatile asset class went from a 0, 1, 2% rate of return to a 5, 6, 7% rate of return, a little less need to have to buy stocks to keep up with a 30-plus year retirement horizon. So what are the factors that we're looking at, and why do we still remain optimistic, though, on equities in the long run? We do have potentially the final Fed rate hike happening, so we'll see how inflation plays out over the coming months. The Fed has been kind of back and forth on guidance for the market on if they are really done or if we're going to continue to see some rate hikes. A lot of that, again, will be dependent on the inflation numbers. Markets typically rally after recessions, as you can see on the right side of the graph here. We're still in the early stages of a bull market. So we had a lot of stuff going on in the economy coming out of 2020 with COVID. We have record amounts of cash on the sidelines. So there is around $5.5 trillion, 5.5 trillion with a T, money sitting in cash and money market accounts on the sidelines. That's not money circulating through the economy. That's not creating a velocity of money yet. But when consumer sentiment picks up, people start feeling a little bit better. Maybe we're starting to get through this recession. That capital comes back into the markets. It starts making its way through the system. that can help spur economic growth. And again, we still have relatively subdued investor sentiment as an example of that 5.5 trillion. People in general are still not feeling great. So they're pretty cautious with making investment decisions. They're pretty cautious with spending decisions. If we can get some more positive sentiment over the longer run, that money starts to get spent, that money starts to get used. That'll help drive equity markets. Again, remember your time horizon when you're looking at investments. Now, as we look at if we're going to buy stocks, what are the types of stocks that we want to buy? And we've had lots of conversations around this in previous town halls. We continue to be big proponents of the US markets over international and emerging markets. If you look there on the left side, the earnings per share growth. So we just talked about how important earnings are. The earnings per share growth, you can see the S&P 500 over the last 5 years at 9%. European markets between 6 and 7, the rest of the international markets closer to 4, and then you got Japan, which is struggling to grow at just 2%. So we continue to want to have a focus of big companies in the US that have that profitability, that have that earnings growth to help drive the markets, again, moving forward. Now, on the next slide here, we're going to start to talk about asset allocation, and this gets back to that comment I made just a couple minutes ago around if we're an investor, we now have to decide where do we want that money invested. Is it in stocks? Is it in bonds? Is it in real estate? Now, as we start to look at some of the graphs here, this looks on the left side at what's the return of typical markets looking at inflows and outflows out of equity funds. So what it shows here is that in the month of an outflow out of the equity market, so investors are saying, I want to get out of equities, the equity market tends to be down during that time frame. The following month, though, the markets tend to be up 1% to 2%. The month after that average outflow, though, we start to see 1% to 2% again market growth that immediately after, and then again another 1% the preceding month. But if we start to go out now 3 months, after money is starting to flow out of equities, you see a 3-month return of just shy of 5%. If you annualize that over a year, that's close to 20% rates of return. Again, a great quote from Warren Buffett: be fearful when others are greedy, and greedy when others are fearful. It's very easy to get caught up in the here's what's happening now, but every time the market pulls back, it is an opportunity to get into things at lower prices if you have the time horizon to ride through that. There's also a really interesting CNBC market turmoil. They run a special every once in a while when the market's really in turmoil that says, hey, the market's in turmoil, everybody panic. The markets are up 99% of the time after they've run a market turmoil. So again, everybody panics, drives down the markets. Well, if things come down enough in price, they create unique buying opportunities and opportunities for that market to continue to grow. So we're going to wrap up here and jump into Q&A. So as Vanessa mentioned earlier, if you have some questions, please go ahead and write them in the Q&A section, and I'll kick it back over to Vanessa to run us through Q&A.
Again, in the Q&A section, as Aaron just mentioned, if you type those, we'll try to get to as many as we can. We do realize that this presentation was a bit longer than most of them, so we'll try to get wrapped up here in the next couple of minutes. The first question, Donna, if you want to answer it, is isn't more government spending just creating a false economy as opposed to an economy growing due to supply and demand relationships?
Thank you. That'll be fun. Great question. And going back to the 1800s, the economy really only grew because of supply and demand. It didn't really change until World War I when we instituted the income tax and the ability for the US government to issue debt as it deemed fit, which gave it the ability at that point to then fund wars and grow the economy at any pace that it could get Congress to agree to spend. So yes, that is true, but being 100 years hence, it's not something that we can revert back and get back to those good old days of true supply and demand. It is now driven by Congress, and there's no going back.
Great, thank you. We have another one, Aaron. Any thoughts on real estate given where interest rates are?
Great question. Real estate's a really interesting asset class to look at because as interest rates rise, generally speaking, real estate is impacted because, again, you've got a trade-off between what you could get from just leaving money in the bank to what that real estate could be generating, and you've got the cost of capital, right? Mortgages for a lot of folks on this call are at 2.5% to 3%. New mortgages are at 7% and 8%. What's kept the residential real estate market stable is the fact that all those folks at 2% and 3% mortgages are going to have a really hard time selling their house and justifying to themselves on why they need to sell that real estate and get into a new house at 7% or 8%. Meaning there's a lot less inventory on the market. Nobody's putting up their home for sale because they don't want to trade from a 2.5% mortgage to an 8% mortgage. So with that lack of supply, we've been able to keep up housing prices, especially here in the California Bay Area, as well as the fact that the tech sector has been doing well. It's really 7 companies that have been driving the S&P 500 this year. Those companies being profitable really helps hold up the residential real estate here. Commercial real estate starting to show some signs of cracking though, because with residential real estate, people are signing up for 30-year mortgages, meaning they don't need to make any real estate decision for another 27 years because they've got that interest rate locked in. Most commercial real estate loans are 5, 7, maybe 10 years at most on a fixed term. So those loans are starting to turn over and people are going to have to make a decision. They can't just wait it out and hope interest rates are going to go down. They've got to adjust for that rising cost of capital. And as Don mentioned earlier, more and more vacancies on those properties.
We have another question, Don. Any expectations of the U.S. involvement in war in the Middle East and what impact there would be on the economy?
Definitely a topic du jour right now. Thanks for the question. The involvement depends on the definition. Right now, we are involved in Russia-Ukraine because we have sent approximately $200 billion to Ukraine in addition to our typical NATO payments. So we're involved monetarily, we're involved with our defense industries, providing missiles, et cetera. So we're involved that way. It's not for us to decide whether we put boots on the ground infantry. I think it's unlikely. War has gone to different levels now that we don't use infantry per se. And then as far as Israel and Palestine, what's going on there is, again, we're looking to go in monetarily with, I think the House today passed a $14 or $15 billion budget. The second part of that question on the impact of the economy, our clients that own either the S&P 500 or USMB or value stocks, because defense stocks tend to be value stocks, are already receiving the I'll call it unfortunate run up in those stock prices as the world has been heating up. So clients ask what they should do. They're probably own more than they already think they do in defense stocks because of the typical holdings that we advise our clients to own. So, but the impact on our economy, unless it's on our shores, it's not going to slow down consumer spending. And if anything, that money is going into these companies, making its way down either to dividends and earnings or to employees and being brought back into our economy. That's how that works right now.
Since we've already gone about 45 minutes, we're going to wrap this up. Thank you all for joining us today. If we don't see you before the end of the year, have a wonderful holiday season with your families and loved ones. And we look forward to talking to you in the new year. Thank you so much.
Thanks, everyone.